Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies, Palantir Technologies, and MULN Automotive. We'll be going over their latest news developments, price targets, future predictions, as well as where these companies are headed in the future. Today I'm going to go over some rather bearish negative articles just because I feel like it, because it gives you a better opportunity to identify both the pros and the cons of each of these companies. Normally I report on very bullish positive articles, but now I want to give you a look into the bearish mindset just so you can make a more informed investment decision. We'll be going over their earnings projections, when their earnings reports are coming up, and where I see these companies in the future. So for more videos just like this one, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump into these bearish articles. Let's start off with SoFi Technologies, which essentially operates as a digital bank, and their ticker symbol is SOFI. SoFi Technologies' stock journey is far from over as the economy begins to slowly show improvements and macroeconomic easing, which is on the horizon. Investors are starting to dip their toes back into speculative stocks, and the more investors buy speculative stocks, the more it looks very good for SoFi Technologies. But before these investors jump back in blindly to various beaten down growth stocks, and before they jump on the SoFi bandwagon, let's look closer at this company of what's really going on and whether or not SoFi Technologies is a good investment opportunity. And remember, this is a bearish negative video. First and foremost, let's talk about the elephant in the room, and that is SoFi Technologies' student loan saga. As you probably know, SoFi Technologies' fortunes are heavily tied to the situation with the government-backed student loan moratorium, which was supposed to end multiple times. Because of this, the company has since diversified themselves to become a digital-first financial institution, which ultimately is good for the company over the long term. But this company actually started out doing student loan refinancing, and that's still their bread and butter. Their lending segment still brings in the majority of their revenue. However, since then, their student loan segment, due to the student loan moratorium payment pause, where various people who own student loans don't have to make payments and their debt is not accruing interest, this has de-incentivized anyone from refinancing their student loans with third parties such as SoFi Technologies. But hold on, it's not all doom and gloom. The student loan repayment pause is set to end later this year if an upcoming Supreme Court case is resolved quickly. However, there is a catch, because recently the U.S. Department of Education has proposed new policies regarding an income-driven repayment program, to where now investors can pay back as little as just 5% of their discretionary income that they are bringing in. This even reduces the overall incentive for student loan borrowers to refinance their loans in the private market. This ultimately hurts SoFi Technologies pretty badly, because SoFi wants to bring people in through their student loan refinancing and then cross-sell them and upsell them on other products. Without SoFi Technologies originally being able to bring these customers into their ecosystem, it hurts them tremendously. And if that wasn't enough, SoFi also faces other issues, such as a current downtrend in the overall macroeconomic environment right now. So what's the overall verdict? Well, according to this article, the student loan moratorium payment is going to be either extended or new policies will come out regarding the student loan payment, which will de-incentivize various borrowers from refinancing with third parties. The proposed changes that are set to be made for the repayment plans and other issues at hand may not go very well for SoFi Technologies in the long run. So with this recent development, it could make SoFi Technologies less than appealing. So skipping out on SoFi Technologies remains the best move according to this article, to where they highlight that SoFi Technologies earns a D rating in Portfolio Grader. So overall, this is a very bearish article. I just wanted to give you all something to weigh against my very positive outlook on this company, because in the end, this company is still very well structured for long-term growth. The overall company is rapidly evolving and investing in all three of their business segments, and through them diversifying in their overall revenue streams, this company still could be a long-term winner. But with that being said, I only have a 4% allocation to this company, and I don't anticipate to buy more of any of these shares to reach a 5% allocation until the company drops to around $3 to $4, if it even drops that low. I also want to highlight that on January 30th, SoFi Technologies will be releasing their earnings report, to where they are anticipated to bring in an EPS loss of 9 cents, and their revenues are supposed to come in between $425 and $427 million. So if that goes well, we could see an initial increase in their overall share price, but in the end, it looks like SoFi Technologies will have to buckle down until 2024 when the company is supposed to become profitable. Up next, we have PLTR Technologies, who is also supposed to release their earnings report, and that is going to be on February 13th of 2023. PLTR Technologies is a very innovative technology company that serves both commercial enterprises as well as government clients, and if you don't know, they are a big data and analytics company. While many companies have been cutting their overall costs by laying off various employees, PLTR is actually buckling down and hiring more staff this year. We went over in a previous video how the CEO, who is Alex Karp, announced that he is willing to hire hundreds of more workers and take on new employees. And in the most recent quarter, PLTR released very good overall financial results of bringing in revenue of around $478 million for the period ending September 30th of 2022, and that overall equates to a 22% increase in their overall revenue growth rate. And even though the company noted headwinds due to foreign problems, it is still raising its guidance for adjusted operating income for the overall year, which is a positive development. But what sets PLTR apart from other technology companies? The majority of the revenue comes from government customers as of right now, but in the future, I believe that their commercial clients will be their new bread and butter, and that's what's going to cause the company to achieve profitability. In a recessionary environment, PLTR's business may struggle as the business starts to scale back on various types of spending, but the overall impact may not be as significant as some investors would lead you to believe. Now, before you go running to buy PLTR Technologies, it's important to note that the company's net loss over the last 12 months totals around $560.8 million. And with the business operating expenses being a whopping 90% of their overall revenue, investors may be more concerned about the likelihood of this company turning a profit anytime soon. Current projections put this company out until 2025, and that's when the company is supposed to become profitable. So it's important to remember that this is a long-term investment and not a short-term investment, to where if you want to invest into this company short term, you're not going to make a lot of money on this. In the meantime, you also need to bear in mind the overall macroeconomic environment that is going on right now, which is unfriendly to various technology companies, including PLTR Technologies. So in short, PLTR's decision to hire more employees and releasing very positive projections for their upcoming earnings report on February 13th shows very prominent good growth prospects, but unless the company becomes profitable, investors should approach this company very carefully. And again, you have to remember, I'm analyzing a very bearish and negative article. Overall, in essence, in my opinion, if you want to hold this company for the long term, it's going to be a great stock and a great company to buy, but if you're willing to hold it for the short term and you can't stomach the volatility of the short term, then this company may not be for you. Lastly, we have MULN Automotive, which is an electric vehicle company, ticker symbol MULN, and it recently held a special shareholder meeting where shareholders got to vote on various proposals. The first proposal, called Proposal Number 1, was a reverse stock split, and the results have finally been released to where MULN has initiated a reverse stock split as of Proposal 1, to where the majority of their shareholders voted for a reverse stock split. Now, this is good in the sense of MULN will be able to stay publicly listed on various indexes and on the public stock market, but the problem is that once the reverse stock split goes through, historically we know that short sellers absolutely short the mess out of companies who recently undergo reverse stock splits. This is very negative for the overall company, and I think it's going to draw more attention to this company in a bad way, to where more people will be shorting them, thus artificially suppressing their overall share price. Overall, I am not impressed with MULN Automotive. I don't think it has good financials or fundamentals, and until the company can either manufacture vehicles at a competitive rate, sell their vehicles to start making some revenue, or become profitable, this company is not going to entice me to invest into it as of right now. But if they meet any one of those three criteria that I mentioned, then I would think about investing into this company. But right now, it is a mixed bag on the reverse stock split, and they also voted favorably for their number 4 proposal, which is them issuing $150 million worth of notes and $190 million of additional Series D preferred stock. Overall, I think they are planning to dilute shareholders further and take on more debt, and the reason for this is that they need to offset their very negative balance sheet that they have right now because they don't have a lot of money. However, bulls for this company will see the reverse stock split and issuing of new shares as a sign of growth and expansion for the overall company, so they would say that it's worth keeping an eye on, but I, on the other hand, would say that you should approach this company with extreme caution, and I personally am not investing into it. But I would love to hear your thoughts down below on SoFi Technologies, PLTR Technologies, and MULN Automotive, and these very bearish developments that I decided to release to you, just so you have a good concept of both the bull and the bear, the positive and the negatives. I don't want to lead anyone astray, and I want to present both sides of every stock that I report on. So remember to go and smash the like button right now, comment your thoughts down below, subscribe if you are new, and I will see you in the next YT video.